I think on my tombstone, I wanted to say Ed Yardeni was usually bullish and usually right. These perma bears have been around for a long, long time. I think what they're missing now is a global perspective. They did perceive that it would take a recession in the United States to bring inflation down. And I've been pointing out that China's recession is bringing inflation down on a global basis, certainly for goods. I think what else they're missing is productivity. We've had these productivity miracles before. We had one in the late 50s. We had one in the 60s, a mini one when Reagan was president. And then there was another productivity growth boom in the 1990s. And I think we're in the early stages of another productivity growth boom. We actually think productivity could grow 3 to 4% on an annual basis over the rest of the decade.
Hi, everyone. I'm Maggie Lake, and today I'm talking macro with Ed Yardeni, president of Yardeni Research. Hi, Ed. It's great to have you on the show.
My pleasure, Maggie.
So you have a reputation as a market bull, and you've been right about the U.S. economy and the stock market being much stronger than expected. How are you feeling about both of them now?
Feeling pretty good about it. The economy just continues to crank out really good economic indicators. Real GDP certainly has not been in a recession. It's continued to grow. Recently, it was actually revised higher. And at the same time, the stock market's had a great run. I'm thinking that it needs to cool off here a little bit, maybe move sideways for a while, maybe through year end. And then I think the bull market continues next year. So I think all in all, investors should stay in the market.
You say that with sort of confidence and you seem pretty relaxed about it, but there's so much angst. I cannot tell you the amount of people who I've talked to who are bearish, who are looking for this recession that never seems to come, who are worried that the stock market is in a bubble, you're going to see a huge pullback. Why do you think so many people are worried about that? What do you see that they don't?
Well, we've been positive on the economy since 2020, when everybody increasingly turned negative on the economy. Look, it made a lot of sense to turn pessimistic when the Fed raised the Fed funds rate by over 500 basis points in a very, very short period of time between 2022 and 2023, and inflation soared. But in the summer of 2022, when inflation was peaking, we said, we think it's peaking. And we thought it would get back down to 2% just around now. And here it is right around 2%. So I think first and foremost, inflation has turned out to be, to a large extent, a pandemic-related issue. Clearly, fiscal and monetary policies contributed to it. But there has been a recession that's brought inflation down, and that recession has been in China. China's exporting deflation, so that's brought goods inflation down. Not just durable goods, but also non-durable goods. Oil prices have come down substantially because Chinese demand has been very, very weak. So a lot of the disinflation has come from deflationary pressures coming out of China, which is in a very significant property bust, which I think will continue. We also thought that the services inflation rate, rent inflation, would moderate, and that's been the case. But the other thing is we're kind of betting that the consumer would continue to consume. I've always said, don't bet against the consumer. And I've also pointed out that when we Americans are happy, we spend a lot of money. And when we're depressed, we spend more money if we have it. And certainly when the government gave everybody 3 checks, that kept the economy roaring ahead. But we didn't buy into the excess savings argument because well, I have to confess, I have some inside information here, and that is I'm a baby boomer. I'm not retiring. I got too many expenses. I got 5 kids. But
5 cost centers, that's a lot.
But a lot of my friends are retiring, and the baby boomers have $79 trillion, not billions, $79 trillion in net worth, and they're starting to spend it. So the savings rate's going down, could even actually turn negative. Because they don't have any income to save, and meanwhile they're drawing down their assets to live on, and that's kept the economy growing on the consumer side. And then, of course, capital spending has been very strong because spending on technology is essential if you want to be competitive.
Yeah, that technology spending, that sounds like that's, a fundamental. I just want to go back to inflation, then we'll pick up
Sure.
on some of these themes and whether you see them continuing. The inflation, so many people are in the higher inflation. We're in a new inflationary regime, and they look at fiscal spending they don't see coming down, a move away from capital to labor, shortages and increased pressure on energy
Right.
complexes, and they just see this all as very inflationary. Do
Sure.
you see things differently, or are you just looking at that deflation
Well,
from China as
Maggie,
an offset?
Maggie, what I love about the pessimists is that most of them, or many of them, are perma bears. They're only looking for what could possibly go wrong, and I love them because they do all this work for me. I mean, I don't have to come up with everything that could go wrong. They do an outstanding job of it, and all I do is I say, well, what might they be missing on the bearish side? And I almost could never find anything that they missed. On the other hand, I try to balance things off and say, what are they missing? And I guess as a result of that approach, I've been labeled a perma bull. But Maggie, I don't mind that. I mean, I think on my tombstone, I wanted to say Ed Yardeni was usually bullish and usually right. These perma bears have been around for a long, long time. I think what they're missing now is a global perspective. They did perceive that it would take a recession in the United States to bring inflation down. And I've been pointing out that China's recession is bringing inflation down on a global basis, certainly for goods. I think what else they're missing is productivity. I think productivity has been making a big comeback on a 20 quarter trailing basis. It's a very volatile number, so you have to kind of smooth it out. But the bottom line of it is productivity growth at an annual rate bottomed at 0.5% back in 2015, and now we're almost at 2%, which is a quadrupling. Now, big deal, 0.5, 2%. What's the big deal? Well, the arithmetic of real GDP is equal to the growth rate of productivity plus the labor force. So everything that happens to productivity shows up in real GDP. So if real GDP is quadrupled, if productivity is quadrupled from 0.5 to 2%, productivity is a big contributor to economic growth. And productivity is like fairy dust. It makes everything wonderful. It makes better growth. For better growth, makes for lower inflation. Unit labor cost inflation is down to 0.3%, which is another thing that the pessimists completely missed. And that is, unit labor cost is really the underlying inflation rate in the labor market. It's down to 0.3%. So there's still possible that inflation will continue to moderate. So I think those are some of the key factors that have been missed. And a lot of them have just kind of a one theory view of the world, whether it be monetarist or, uh, I don't know, just a perception of just the deficit is the only thing that matters. And the deficit certainly contributed to the fact that we didn't have a recession and contributed to inflation. But on the other hand, inflation has come down and the deficit hasn't. So I try to be kind of empirical about it. I try to start with the data and then come up with a theory rather than start with the theory and look for the data that supports it.
And they're well aware of the fact that they get labeled a perma bear, and then they have a bias, at least some of them. So the productivity gains, do you see this continuing? It's often called a
Mhm.
productivity miracle, right? Are we going to
Yeah.
see more of that, or have we passed a peak in a cycle that we need to be careful of?
Yeah, we've had these productivity miracles before. We had one in the late 50s. We had one in the 60s. We had a mini one when Reagan was a president. And then there was another productivity growth boom in the 1990s. And I think we're in the early stages of another productivity growth boom. We actually think productivity could grow 3 to 4% on an annual basis over the rest of the decade. And at the beginning of the decade, I like things that rhyme, and 2020s kind of rhymed with 1920s. So we've been talking about this decade being the roaring 2020s, productivity-led growth based on the technologies that are out there that are enabling companies to increase their productivity, which means they're cutting their unit labor costs. So unit labor cost inflation is down, means it increases their profit margins, and it also allows wages to rise faster than prices. So, as I said, productivity is absolutely fairy dust. And this is not really a forecast anymore. It's really a description of what's been happening for the past couple of years. And we just think it's going to continue to be the case. I mean, things along the way could certainly trip it up. And I think the difference between the way I do things and the perma bears is, if you ask me to spend the next, I don't know, 15 minutes bearing you with how bad things could be, I could tell their story. I could, I can be very bearish. But I think if you asked any of them to tell you the bullish story, they kind of like start stammering, and just wouldn't feel right to them to even be expressing anything positive. But I'm perfectly willing to concede that things could go wrong. As a matter of fact, we convey that by at least communicating some subjective probabilities of our scenarios. So the roaring 2020s is 50%, and obviously that's very bullish for the stock market, and it's great for the economy. Doesn't sound like, well, that's all 50%. Why aren't you more bullish? Well, 20% is that we get a 1990 style melt up. So 50 plus 20, I got 70% that it's a bull market. I'm hoping it's not going to be a melt up like the 1990s, because melt ups are followed by meltdowns. But it certainly has felt like a melt up until recently. And so that leaves me 30% for geopolitical risk and domestic political risk, including out of control fiscal policy and deficit. So I'm fully aware of all the things that could go right and could go wrong. But I've been leaning towards the argument that things are likely to be going right.
Yeah. Why do you, and we'll get to some of the risks, but it's important to lay that out, right? I like that you're acknowledging, like, yes, I'm considering
Why
it, and
not?
I'm
You
still
have to.
choosing to say that the probabilities weigh in the favor. 1920s, everyone from what we watch was having a great time, though. And
Great
right
time.
now, if we're
Yep.
in that period where so much is potentially going right, why is everyone so miserable? Why does it feel like there's so much angst?
Yeah, I mean, most people think that the economy is in awful shape, and I'm not expressing a political view here. I'm just being objective. Its economy has been in much better shape than the pessimists expected. Real GDP just came out for the third quarter, all-time record high. Real consumption, inflation-adjusted consumption per household, all-time record high. And people come back to me and say, "Yeah, well, that's just an average, and the rich are, consuming everything." Well, there's kind of a limit to how much they can eat and buying clothing, and once they have their mansions and their rich and their fancy cars, I mean, there's a lot of people that aren't billionaires, and so real consumption per household, I think, is a really good measure of the standard of living in America, and it's an all-time record high. But look, economists like myself, tend to look at inflation on a year-over-year basis and say, "Oh, look, it's really come down. It's down to 2.1% for the consumption deflator, which is one of the measures that the Federal Reserve likes to look at, and it has come down substantially." But most people remember what prices were before the pandemic started, and a lot of those, on average, those prices are up like 25%. Some of the grocery prices are up 40 to 50%. And so it's the level of pricing that I think has a lot of people depressed. On the other hand, when you look at wages have also actually kept up with inflation, particularly for low income people, not for high income people. Salaried workers, for the most part, really didn't get compensated for inflation. So their real incomes have actually been deteriorating with inflation. But they've got the wherewithal to keep doing what they were doing without really going into too much stress. But of course, there are people who just haven't kept up, and their wages haven't kept up, and certainly are suffering. But that's always the case in an economy this size. And the question is, what's the experience on average? And all in all, the economy's doing fine, and real incomes are fine. Real wages are increasing, again, particularly for what's called payroll production and non-supervisory workers, who account for 80% of the labor market.
Mm.
So there's a lot of good things happening out there, but of course there are bad things. And you're right. I mean, we're not seeing a lot of flappers flapping around the way they did in the 1920s. But maybe that means it's going to last longer. I mean, when there's too much exuberance, too much excitement about how nothing could ever go wrong, that's when things start to break down. I think that's kind of what led to the end of the 1920s excitement. But everybody reminds me that the 1920s ended with the Great Crash and then the Depression, and I'm very mindful of that.
Mm.
Um, the Great Depression was caused by the Smoot-Hawley tariff, which was passed actually June of 1930. The Great Crash wasn't that great. From October 1929 until June 1930, the market basically regained half of what it lost. It was back to where it was in April of 1929. It was the Smoot-Hawley tariff that just caused the stock market to absolutely crash and the economy to go into a depression. And
Mm.
again, without getting political, the fact, but nevertheless, both candidates are talking about raising tariffs, and particularly Trump. So that is something to be concerned about. But if it's being used as a way to negotiate for freer trade, then that's a positive. I certainly wouldn't want to see across the board tariffs that cause a global depression, because then my roaring 2020s scenario wouldn't is over, and it wouldn't last through the end of the decade.
Yeah,
But
no one
look,
wants to see that.
there've been
What do
a
you
lot of
make of
scares.
Go ahead.
That's it. I mean, that there've been a lot of scares along the way, and so far it the market certainly looks like a roaring 2020 stock market.
It does, and a lot of people have reluctantly missed out on that because
Yeah.
of some of the fear that paralyzes us. If the outlook is or there are a lot of these positives, what do you make of gold at record highs?
Well, it's actually a pretty simple, straightforward story. The United States slapped some onerous sanctions, and rightly so, on Russia when Russia attacked Ukraine in 2022, in early 2022. And that's when really gold started taking off. And I think central bankers, particularly of our adversaries, the Russians, the North Koreans, the Chinese, it is turning into sort of a bipolar world where we've got the U.S. and its Western alliances, and then of course you've got they call themselves the axis of resistance. A previous president called them the axis of evil, which I happen to agree with.
Hmm.
But these central bankers seen from what happened to Russia that they don't really want to be sitting on much in the way of dollar reserves, so they're buying gold, and it's kind of that simple. And that's why gold just keeps going up and up and up, because these central bankers are doing it more for political reasons than they are for anything else.
Yeah, politically
They're not
driven.
hedging
Does it
against.
feel like that has staying power given that?
Yeah, yeah. I mean, people keep asking me what's the upside. I said, well, maybe gold is going to be sort of like it's catching up with Bitcoin. I mean, who would have thought that Bitcoin would be at $70,000 for something that is just digitally out there, whereas gold is physical, and for a long time it's been viewed as the most reliable, safe haven for against inflation, against political turmoil. And here we don't really have a big inflation problem. Maybe there's still concerns that it'll make a comeback. But I think that the big issue is political turmoil, geopolitical turmoil, and there's been no shortage of that. And that
There is certainly no shortage of that.
no,
I want to ask you about another risk, which you alluded to when you were talking about fiscal
yeah,
spending. So, um, we're in an environment where most people think, regardless of who's in office or who controls Congress, that this is just spend, 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 and
it is.
there doesn't seem to be any fiscal restraint or conservatism
Yeah,
in the states right now. How are you thinking about bonds? And you are the
yeah,
person to ask because you coined the term bond vigilantes. Are you
right.
concerned about the action we're seeing in the bond market?
Well, it's been very interesting. Yeah, I coined the phrase "bond vigilantes" back in the early '80s, arguing that if the Fed wasn't going to be vigilant against keeping inflation down, then the bond market would do so. And there were actually three episodes in the '80s when there was inflation scares and bond yields went up, nominal GDP slowed down, and then inflation continued to moderate. Then in the 1990s, early 1990s, it was President Bill Clinton who was warned that he better not do anything to annoy the bond vigilantes because they had all this power
Bob
And
Rubin, right? Bob Rubin,
yeah,
supposedly that
yeah,
famous story of him
yeah.
talking about the bond traders.
And also, James Carville said, if he was reborn, he'd like to be reborn as, as a bond investor because they had all this power over fiscal policy. So they took it actually very seriously. And by the end of the 1990s, we were actually running a surplus uh, in our budget. Believe it or not, it seems like we've been running deficits forever, but we were actually running a surplus. And then 9/11 hit, and defense spending increased, and the government was concerned it would cause a recession, so the deficit suddenly reappeared big time. But inflation stayed down, and the bond vigilantes figured that as long as deficits were associated with a weak economic activity, that's okay. They could live with it as long as inflation was down. But what's changed is for the past couple of years since the pandemic is we have this huge deficit and mounting debt in an environment where the economy is doing just fine. The Usually in expansions, revenues rise faster than outlays. That hasn't been the case for the past few years, and quite the opposite. It's these a trillion here, a trillion there. Before you know it, it's serious money. I think it was Everett Dirksen who back in the '60s who said a billion here, a billion there, and it's serious money. Now we have to say a trillion here, a trillion there. And so that's where we are. We've got these huge deficits. And am I concerned? I've been saying for a while here that I'll be concerned about the deficit and the debt when the bond market is concerned. I'm an investment strategist. I'm talking about giving advice. And for many years, I've seen people absolutely freak out about the deficit, and they completely got too pessimistic and missed a lot of great bull markets in bonds and stocks. And I got real concerned last August, September, October when the bond yield went from 4 to 5%,
Hmm.
because a couple of bond auctions went poorly. So suddenly I said, "Hey, I think the bond market cares. The bond vigilantes are back." And on November 1st of last year, Janet Yellen came up with this ingenious way to calm them down. She basically told the bond vigilantes, well, if you don't like my bonds, I'll just issue a lot of bills. And so they've been financing the deficit with a lot of bills that doesn't put a lot of supply pressure on the bond market. But now we're seeing the bond yield go up again. And we actually anticipated that people were expecting the Fed to lower interest rates much more than we thought. And then the Fed came up with a 50 basis point cut, which surprised us. And we responded to that by saying they're going to regret it because the economy is going to look good and the bond yield is going to go up, which is totally contrary, right? The idea that the Fed cuts the Fed funds rate by 50 basis points, the bond yield goes up by 60 basis points.
Yeah.
Now, how's that possible? Well, it's happened.
So it
I'm
feels
worried
like the
about.
bond
I'm worried about it.
vigilantes are back because that
Yeah,
people forgot about them, frankly. I
yeah,
remember you talking about that and then we heard nothing for
nothing.
but
Yeah,
now does it feel like they're back or is this just a kind of shot across the bow? How
it
serious could this get?
it's starting to feel like they're back. I don't want to. Again, I feel a responsibility to be balanced about these things and call it as I see it. And seeing a 60 basis point increase in the bond yield when the Fed just cut by 50 basis points, and when oil prices just came down. Israel attacked Iran. Iran said no big deal. The Israelis said no big deal, but everybody knows it was a big deal. I mean, basically, the Iranian defense system has been totally annihilated. So next time Israel wants to go in there and knock out some other facilities, it'll be wide open. So it was a big deal, but I think neither side wants to make a big deal about it right now. So the price of oil took a dive on that right after that attack. Once it was clear they weren't taking out any oil facilities, and there has been a really good correlation between the bond yield and the oil price. And here the oil price takes a dive, and the bond yield keeps going up. So that's got my attention, and it
Mm.
suggests to me that well, the supply issue may be coming back to the fore. And of course, the Fed cut the Fed funds rate 50 basis points on September 18th, and singing a happy song like, okay, everything's good, inflation's almost where we want it to be, and we're probably going to continue to lower rates. And I thought that was insane because I mean, don't they know an election is coming? And don't they know that both candidates are talking about fiscal policy that'll only widen deficits? Why would they want to just kind of get themselves stuck with this idea that they're going to ease when they might have to change their mind here pretty shortly. Do they really want to accommodate fiscal policy? I think the problem, Maggie, is that the Fed has this in your lane kind of view. We stay in our lane on monetary policy. We don't comment on fiscal policy. That's up to Congress and the president. We want to maintain our independence.
It's called job security, right?
Yeah, I mean, they can't ignore fiscal policy, and that's what they seem to be doing.
So why do you think they surely know all this? Why do you think they cut rates by 50 basis points?
It really does beat me. I mean, last time that on August 23rd at the conference in
Jackson Hole.
Jackson Hole. Thanks for helping me on that.
That's okay.
On Jackson Hole, Powell surprised me and everybody else by becoming, pivoting pretty dramatically. He's known for pivoting, but this was a pretty dramatic pivot from hawkish, let's maintain our restrictive stance until we're sure inflation's down, to suddenly uber dovish, very dovish. And the last time I saw him do that was just before inflation soared. It was inflation soared in 2022, 2023. In 2021, he was giving very woke speeches about how the Fed really it's got a dual mandate of keeping unemployment down and inflation down. And he basically said, we're definitely focused on keeping the unemployment rate down. And then, of course, inflation came roaring back. And then all of a sudden he's saying he pivots again. So now we're 100% committed to bringing inflation down, even if that causes a recession. And now at that Jackson Hole speech in August, the most recent one, it was back like, we're going to just focus on the unemployment rate. We don't want to see it go up much above 4%. And would you know it, the unemployment rate was 4.3% when he said that, and now it's down back to 4.1%. And some of the labor market indicators look pretty weak, including payroll employment back then. Now they look very strong. And so I think they're going to pivot. I guess I'm still in the contrary camp of none and done. I don't think they will cut the rate in November, and I don't think they'll cut the rate in December.
It's going to be really important what they say. So, part of all of this is feeding into this great economic environment. So in your risk of probabilities, or your probability of risk, where does the bond market fall? Because if we see them continue to, if the Fed loses control of the bond market and those rates go up, that's a party crasher, isn't it?
Yeah, well, that's the advantage of forecasting with subjective probabilities, because you can change them. It's subjective. It's my opinion. It's just my way of conveying how I think things are shaping up. I mean, I do have a crystal ball somewhere back there, but
well, people are beginning to wonder, because you've been contrarian and bullish for a long time, and a lot of the time you're right. So,
well, I just as a by the way. I have some inside information on all this. I have a relative who regularly calls me up whenever the market hits a bottom, and he panics and he says, "Should I get out?"
That's your contrarian. I feel like we all have one of those.
Yeah. So listen to your relatives. If they know you're in the financial business and they're calling you up and it's saying, "I got to get out," don't I? That makes bottoms when sentiment is that pessimistic. Also, I have 5 kids, so I can see that they're spending money. So I had faith in the economy.
You have your real economy indicators as well. So what level of bond action would start to make you concerned? Like what is a rate that the economy and the stock market can live with, and what starts to get dicey?
Well, I'm not a technician. I don't look at the charts and tell you exactly what's going to happen. But I have a lot of respect for the technical analysis. I mean, looking in the chart is kind of like, a Rorschach. It's looking at, what do you see? And there's a lot of information in there about psychology, and because a lot of people do trade off of charts, it's worthwhile seeing what they're saying. So I'd say just on a chart basis, here we are basically back above 4%. Looks like, instead of 4.25%, we may be soon in the 4.25% to 4.5%. I can't dismiss the possibility that we'll retest 5% to see if that can hold, if there'll be buyers there. There were a lot of buyers last time around, But I don't think we're going to go that far. But I, again, you're asking me where that fits in my scenarios, and I kind of shoved it into uh, that scenario of geopolitical risk and
Mm.
domestic political risk, including the deficit situation. So that's
Yeah, and that
30%.
that fits in political because it sounds like that you think that's what it's keying off of rather than inflation, which it sounds like you expect to be well behaved. What is your in that environment? You'd mentioned before that you're bullish stocks long term, but you're a bit concerned about valuations here, and we
Right.
are seeing that right now as we make our way through another earnings period.
Sure.
Does tech feel bubbly to you? Are you looking at the how does that fit in with the broader market, and what does a sideways
Yeah.
versus your ultimate targets look like? Walk me through your
Yeah.
stock scenario.
Well, we write a daily called Quick Takes, and I always need to have some catchy title. You can accuse me of clickbait or whatever, but catchy is better than boring. And so the one my associate Eric Wallerstein and I are writing, I just like gotta. Sometimes I just get an amazing insight before we even sit down and write it. And I think we're going to call it super macro versus super micro. And there's this company called Supermicro that was a huge AI play that just kind of imploded because Ernst and Young, EY, I walked away and said we really don't want to certify your accounting. And so I think we may be taking some air out of the AI bubble. I think there's a lot to AI. I think it's kind of like what happened in the internet in the 1990s. There was an internet bubble, a dot-com burst, but here we are, and look what we're doing on the internet. We're having a conversation like we're sitting in your living room
Mhm.
or my library or whatever. So I think there is some excess there that some air can come out of that. I was thinking that the bull market would broaden out to the Russell 2000 and to the smaller cap stocks and to the rest of the S&P 500. But now with the bond vigilantes kind of saddling up and threatening to be more vigilant, I think the Russell 2000 isn't going to do as well because I think it was doing well when the perception was that interest rates are going to come down sharply. And that was because people were looking at their charts and said, it's always come down sharply once the Fed started lowering their interest rates. And I said, well, yeah, the difference, though, is we haven't had a credit crunch or a recession. So they're not going to come down sharply this time around. So I think the market's just going to have to go up with earnings rather than valuation. We have to take some of the excitement out of the PE. The PE for the S&P 500 is, last I looked was around 22 for forward earnings based on analyst expectations, and the peak in the 1990s bubble was 25. So we're kind of close. The Buffett ratio, which looks at the stock price index, the S&P 500, relative to revenues, is well above where it was back in the late 1990s. And Buffett says whenever it's above 2, you want to start being careful. And looks like he's starting to be careful. He seemed to be raising some money. So look, we've had a lot of fun here in this bull market. We called it back in late October, early November of 2022, and I wouldn't mind if it kind of had a rest. But the economy is still doing well. Earnings are still doing well. We're looking for profit margins to continue to expand along with productivity. So if the market discounts the improving fundamentals of the economy, and in other words, goes up with E rather than PE, with earnings rather than the valuation multiple, I think we could see 6,300 next year and 8,000 by the end of the decade. It's just, when it soared above 5,800 a few weeks ago, all my competitors suddenly jumped to 6,000. I said, you know what? I'm going to stay here with 5,800. I think this thing needs to rest here for a while. It's a little bit too exuberant.
Yeah, it's interesting. You're laying out a scenario where it can rest, consolidate, maybe see with some internal rotation, but it doesn't mean it has to go down
Well, you
a
can. I
huge
mean, look,
amount, which is
yeah,
what
look,
the expectation is, I
yeah,
think. Oh, we had this great
yeah,
bull run. Now we've got to slam down
yeah,
and suffer these terrible losses and a terrible
yeah,
bear market before we can. You see a different path.
yeah. Look, I'm not going to tell you we couldn't have a 10% correction. I don't think we would have a correction up to 20%. And I don't think we're going to have a bear market of 20% or more. I mean, anything can happen that would make me wrong on those things. But generally speaking, corrections occur when people, widely speaking, fear that that something has happened that'll cause a recession, and then it turns out that that's not the case. So we get a correction. We get 10 to 20% decline, and then everybody says, got scared over nothing, and that was a great buying opportunity. Bear markets occur when the market's already down 10 to 20%. It's already in correction territory. And then boom, it goes down to 25 to 30, maybe even 40, 50% down because the recession actually hits. That's kind of what happened during the great financial crisis. The market was basically in a correction phase, or a very mild bear market phase, up until Lehman blew up. And then, then the market took another huge dive from there. So I don't really see a correction mode, because I don't think that there's much out there that risks a recession happening. The Fed's focusing on easing, not on tightening. Maybe it'll be geopolitical risk, but we can't even get all these horrible situations around the world to drive the price of oil up. That just tells you that, China's weak, Europe's weak, and oil's a key driver of inflation. I mean, if Trump's elected, he's talking about pumping out even more oil, which would drop oil prices even more. And even under Biden-Harris, we're producing 13 million barrels per day, all-time record high, and that's helped to keep energy down. So without a major spike in oil prices, again, I don't see a recession.
These positive economic fundamentals and the productivity fairy dust and lower oil prices, is this something that can benefit the broader global economy, or are you more bullish U.S. and putting U.S. in a different class than some of the other economies around the world?
Yeah, well, we have been telling folks to overweight the U.S. in global portfolios. We've been saying that since 2010. And one of these days, I may very well overstay my welcome on that position, but we're still telling people to overweight the United States. So we would stick with the U.S. It's a much bigger, much more diversified economy than anybody else's. China's obviously gaining some traction, but it's got this bursting property bubble, and it's got a terrible, rapidly aging demographic profile. So they're not much of a competitor. Europe's got the same kind of issue with aging demographic and not being very competitive. And look, we've got the technology industry is still pretty much the epicenter, still in the United States. So I would continue to overweight the United States.
Mm. A lot of people, as they're going to get through some of these trying times we have, they're going to look at their portfolios. They're going to try to figure out what to do. What's a good question you think people should ask themselves as they try to sit down with either their financial advisor or their partners or whoever it is, and they're looking at their portfolio? They may be feeling nervous. What's a good question to ask yourself when you're trying to figure out what your diversification should look like?
Well, I think not everybody has time to look at the markets on a regular basis the way you and I do, and so it's very difficult for an individual investor or a household to really sort out where they should be. It's hard to answer that question, because you really got to sit down with somebody you trust, and or maybe interview a couple of people, or ask friends of who's done well for them. But diversified portfolio is pretty straightforward. You own some bonds, you own some stocks. These days, you can own some gold, and if you're not feeling comfortable with too much risk in that regard, there's absolutely nothing wrong with money market funds or deposits these days. And it looks as though there isn't going to be a lot of interest rate risk if we're right. If we're right, interest rates these are normal interest rates. They're going to stay here. The scare tactic, especially among brokers who want you to invest, is to say, these short-term rates are not going to be here forever, and they're going to come down, and then you're going to be investing your money markets at 2% instead of 4 or 5%. and then meanwhile you will miss the stock and bond rally. And I mean, that's partly true. I mean, that there has been a very huge bull market in stocks, but nothing wrong if you sleep better at night, earning 45%. I think you'll be able to continue to do that.
Yeah. So cash is a real choice again,
Yeah.
for sure. Great stuff. And it was so wonderful to catch up with you. I mentioned briefly when I was starting out at Reuters, I used to drag a camera crew into your office and
I
interview
remember.
you, and you were very generous with your knowledge at the
My
time,
pleasure.
and you continue to be. So appreciate everything you do and your willingness to come on and talk.
Thank you. Let's do it again sometime.
Absolutely. Thanks so much.
Thank you. All the best.